Stocks trading higher ahead of earnings. HCL Tech's dollar revenue growth is seen at 1.5%, while for Wipro, it is expected to come in at 2.36%. Investors will watch out for commentary and guidance.
The Ministry of Corporate Affairs approves the demerger of NMDC steel plant. Street expects listing of the steel plant in the next 2 months.
Casino operator Delta Corp opens higher after a strong second quarter but gives up gains to trade with losses. The stock also has entered the F&O ban list.
Suzlon Energy wins a 144 megawatt order from the Aditya Birla Group. The 1,200 crore rupee rights issue is also underway. The management will join us later on the show.
Marksans will acquire Teva Pharma's bulk formulation facility. The company also plans to double its India capacity from 8 billion units currently.
Hello and welcome to Chartbusters on CNBC TV 18. I'm Ekta Batra and with me is Mangalam Malu. Well, this is the show where you get all of the buzzing stocks in the next 30 odd minutes. But let's kick off the show with a technical check. We have Ashish Kyal joining in to discuss what he's strategizing for this morning. Ashish, hi, welcome to the show. Well, it is going to be a lot about the global cues, the US inflation data, not to mention that we have the Indian inflation data coming out today as well. But nonetheless, what would your strategy be for the Nifty, which is currently just above 17,000?
Hi, Ekta, good morning to you and Mangalam to you as well. See the overall trend for the market, if you look at past 3 to 4 days, it is failing to close above the prior day high, which indicates that right now the situation is any pullback is going to be short-lived as long as we do not move back about that 17,227. Why that exact level? That's again level that I am observing, and 17,227 has been acting like a magnet. It's not allowing prices to move anywhere. And unless we move back about it, I think any pullback from here will be short-lived. If you get an opportunity to sell at around 17,090, do that, keeping that 17,200 as a stop loss and expecting a target of again 16,950 on the downside. 17,000, we can clearly see a very high OI buildup is there, both on the put side, but also the call is increasing. So looks like a straddle is in play, and that's why we might see a range bound movement until tomorrow in this broad range of 17,190 towards 16,950. That is the broad range I'm expecting on the Nifty. And US remains concerning. We can see it hitting 52-week low, Dow Jones Industrial Average, and there is no sign of any kind of a pullback, and the pullbacks are just short-lived for 1 or 2 days. And again, the selling pressure intensifies. At the same time, rupee is depreciating. We can see that. So a lot of global cues are not favoring the markets. But yes, India is resilient as of now, but I think we will give away.
All right, we will watch that. Ashish, you spoke about a straddle. Ekta, the other day we were talking about what straddles are in the F&O chat, right? A call and a put together. So people are selling that maybe for a 200-point range on either side of 17,000. Ashish, individual stocks, what are you looking at? Because just as we speak, the broader markets, the mid-cap index has turned into the red.
Yes, that is correct. It is better to stick with the large cap. If I'm buying something like Power Grid, it's the top gainer within the Nifty index, and also we can see a good bullish candlestick formation happening here. Volumes are decent enough, so possibility that we can move towards the level on the upside at 230 on Power Grid, maintain a stop loss of 207 on the downside. The next stock is on the sell side is Adani Enterprise. I know this is going against a very bigger up move, but I think over the short term the stock has topped out. We might start seeing selling pressure over here. We can clearly see lower high, low formation. It's trading below that 20 days average also. So Adani Enterprise is a sell, keeping a stop loss of around 3,320 for the target of 2,980.
All right, Ashish, thanks a lot for that. With that, we move on to our special segment where we get you ideas for profit coming in from our colleagues at Money Control Pro. Anubhav Sahu joins in.
So today we are talking about Vijay Diagnostic Center, which is a strong regional player in the diagnostic industry. Now, attention to it is drawn given the sectoral background, where other than COVID revenue cliff, most critical headwind has been the entry of new diagnostic service providers. Now, this has led to a scenario of significant pricing erosion. However, our channel checks suggest that campaign-based pricing offers are not sustainable. Further, we believe within diagnostic service, test quality and data reliability is now a more differentiating factor, given the shift towards preventive care. Now, in this context, it is also relevant to know that only 1 to 3% of the labs in India are certified by NABL. Secondly, if we exclude hospital-based labs, nearly 75% of the diagnostic market is unorganized. Now, we believe most of the visible impact of new entrants will be in terms of consolidation in the unorganized sector. Now, with this backdrop, Vijay Diagnostic Center looks interesting, which focuses on both pathology and radiology. Going forward, company plans to grow through the hub and spoke model with this focus in established markets. Now, the key strength of the company lies in its heavy B2C mix, which helps in relatively better margins and negligible receivables. In addition, company has a strong cash flow conversion. For the balance sheet is lean and valuations are reasonable post-consolidation in last 9 months.
Okay, all right. So that's Anubhav talking about Vijaya Diagnostics. We need to take a short break, but on the other side, the management of Suzlon Energy will be joining in. Stay tuned for that.
Nifty is just hovering about that 17,000 mark, holding up by the skin of its teeth in the green, just about 21 points. It's off the highs. The mid-cap index has moved into the red as well. But as promised, let's get chatting with the management of Suzlon Energy. It's in focus today. The company's rejigged its management. At the same time, we've heard the announcement of a 1,200 crore rupee rights issue and an order win that they've got as well. We are now joined by the Executive Vice Chairman, Mr. Girish Tanti, as well as the CFO, Mr. Himanshu Modi. Thanks a lot, gentlemen, for joining in. Mr. Tanti, at the outset, condolences on the demise of Mr. Tulsi Tanti. We do hope that, you know, his soul gets eternal peace and the family gets a fair amount of strength.
Thank you.
Mr. Tanti, now, while his void cannot be filled, you know, we just wanted to understand from the management continuation standpoint, how will his responsibilities be divided, the day-to-day ones?
Yeah, so thank you. Basically, you know, our incoming chairman and managing director, Mr. Vinod Tanti, and myself, both of us together, have decided to manage the overall role which Tulsibai was playing. So, you know, most of the internal side of the business would be taken care by our chairman managing director, Mr. Vinod Tanti, and I would take care of the external stakeholders and the you know, other matters from the external part.
Okay. Mr. Tanti, deepest condolences for the loss that the family has suffered. Just wanted to continue with this conversation about the transition of management. At any point, has the company considered that maybe selling off stake or moving towards a different type of maybe, you know, management would be something on the cards, something which is not related to the family at all?
No, so I think, you know, there is a very strong foundation that our Tulsibai had set for the organization. And I think we are on a very strong chart now for, you know, growing from here. And you know, we've had internal management discussions with the leadership team, and all of us have jointly committed ourselves to driving the vision and the plans which have been charted out. And we all stay committed, both from family as well as from the management, to deliver on the plans which we have charted out. So there are no plans otherwise.
Right. And we presume that the rights issue is a function of that itself, strengthening the balance sheet of the company. Just wanted to understand a couple of things. What exactly is the consolidated debt on your books right now, both long-term and short-term put together? The money that you raise from the rights issue, will that entirely be used to repay debt? And how much will your annual finance costs come down to?
So our consolidated debt as of 30th June 2022, quarter ended Q1 FY23, was about 3,200 crores. The rights issue proceeds, as you know, is about 1,200 crores, out of which 900 crores would go towards debt repayment, and the balance, about 300 crores, is for general corporate purposes and meeting out issue expenses. That's, of course, assuming the issue size is fully subscribed. So in tranche one, which is, you know, out of it, since it's a partly paid share, out of the 1,200 crores, we are calling for 50% of the paid up amount. So roughly about 2.5 rupees per share, which would translate into 600 crores in tranche one, of which 16.5 crores is the estimated issue expenses. So 583.5 crores in tranche one would go towards debt repayment. And from the subsequent tranches, another 316 crores would go into debt repayment as and when the subsequent calls are called for. So total of 900 crores would get reduced from the 3,200 crores as on June 30th, 2022. Of course, in addition to that, there are scheduled repayments that we have as per the loan agreements, which the company's cash flows are robust enough to be met on a regular basis from time to time.
What is
So
the
March 23, whilst I'm not in a position to give you a number, but the debt size would be significantly leaner and meaner as compared to the June 22 balance sheet.
Can you give us what your ideal consolidated debt would look like? What is the company's internal target? You said that you do have a repayment schedule. Give us a sense in terms of what a comfortable debt figure would look like. And after this rights issue, we would assume that the fundraising is closed from the company's end, at least for some time. And if so, for how long?
So, I mean, whilst, as I said, since we are in the silent period and in the middle of rights issue, I do not want to give any outlooks. But our EBITDA is close to about 850 crores for FY22. And I think, from a management perspective, a debt to EBITDA of about 2:1 is what we would be targeting to get comfortable with going forward.
So that's about 1,700 odd crores. Just wanted to press a little further on the interest costs as well, because FY20, your interest costs were closer to 1,400 odd crores. FY21, they slipped to sub 1,000 crores. FY22 was 735 odd crores. The first quarter interest expense was 148 crores. And you in the presentation have said that reduction in finance costs by virtue of all the other things that you're doing, the full impact will be visible in the second quarter. That plus the debt repayment that you're making, etc. Just wanted to understand, what will your interest costs or interest expense finally settle at?
So if you see our interest costs, as you said, historical for FY21, FY22, or even the first quarter of FY23, a large component of the interest cost was non-cash interest cost, which was resulting from the 20-year instruments by way of optionally convertible debentures and certain preference shares that were issued to erstwhile lenders, which no longer exist on the balance sheet, as we've converted those instruments into a liquidity listed shares of the company and allotted those to the lenders. Therefore, the non-cash interest cost will significantly come down. It will become virtually zero. And our existing borrowing that we have is at about 9.5%. So, I mean, about 300 crores on a current run rate basis would be the interest cost. Of course, from the rights issue proceeds, as we pare down the debt, assuming a 900 crore reduction, we would have a total 90 crore interest cost saving further beyond what we would see in the Q2 results as and when they come out.
Okay. Mr. Tanti, this question is for you in particular. Mr. Sanghvi is one of the investors in Suzlon. Now that there is this transition which is taking place, have you heard or have you had any conversations with Mr. Dilip Sanghvi? What might his participation be in Suzlon at this point in time? He is participating in the rights issue, but besides that, on a larger, more fundamental basis, would there be any kind of participation from Mr. Sanghvi?
Yeah, so, the Sanghvi family has been a critical, important partner for us in our journey. And we have had discussions with them as part of the transition plan. And, there wouldn't be any change as regards to the understanding of the relationships we have. So there's not going to be, their participation shall continue as before. And, the day-to-day affairs of the businesses will be managed by the family. And we have a very strong management team in place for all our divisions. So I think together we will continue to manage the business like before and continue to seek guidance as and when appropriate from Mr. Dilip Sanghvi.
Mr. Tanti, assuming that the rights issue is done in a pro rata basis, promoters participate, like you've mentioned, etc. The post rights issue shareholding will still have promoters hold about 14.5% stake. That makes you susceptible to, being acquired, perhaps forcibly as well, outside of your will. by people who might be looking at opportunities out here. Is that a possibility? What are you doing to prevent that? And have there been any conversations at any point in time to sell the stake?
So, as I said earlier, the family does not have any plans to sell the stake, and the plans are pretty firm in terms of the growth plans from here. And family as well as the management all stay committed to deliver on those plans.
But the family doesn't have more shareholding as well. 14.5% is the shareholding that you have. There are a lot of funds that hold stake in the company. What if it is, the non-promoter stake is acquired by any entity? Your thoughts?
So difficult for us to, at this point, speculate on any of these scenarios. Obviously, the promoters and the management team stay fully committed to the cause. Any of these events are purely speculative and hypothetical in nature. If and as and when should the company be confronted with such situations, we will, of course, appropriately react should such a situation arise.
And there hasn't been any offer?
Sorry, can you repeat that?
There hasn't been any offer yet for Suzlon?
Sorry, we couldn't hear. Your audio is not.
There hasn't been any offer yet for Suzlon. Would you say that?
Your audio is still not clear.
Ekta, you want to try this?
Any takeover offer which has come through, Mr. Modi? That's what Mangalam is asking. Or Mr. Tanti, if you want to take that question as well.
Not yet. I can confirm that not yet. We haven't received it.
Okay, Mr. Tanti, just before we wrap up this conversation, at one point in time, Suzlon had a different glory to it. But if I look at your financials, revenue was at around 6,000 odd crores in FY22, but there have been losses continuously. For example, FY20, your loss was over 2,600 odd crores. You are looking to reduce debt quite considerably. But give us a sense in terms of when Suzlon can start reporting a stable amount of numbers, both on the EBITDA as well as in terms of the profitability going forward. What might the long-term plan be to get it back to its probably glory days that we've seen years before?
So short answer is hopefully soon, but of course the long answer is that there are enough tailwinds we are seeing in the industry, and that is evident by the order book that we have available. If you see FY22, we did a 800 megawatt delivery or revenue recognition, as we call it. And if we see our active order book currently available with us today, based on some of the recent announcements made by the company, we have about 1 gigawatt of active order book confirmed available with the company today. Now, that order book availability, along with a much more lean, mean balance sheet with reduced fixed costs, reduced interest costs, I think we are definitely on the path of a good performance for the company. Of course, from the numbers perspective, our Q2 results after the rights issue would be out by end of this month or early November, as in when the board reconvenes, and the markets would hear about the performance at that point in time.
Take that point. Thanks a lot, Mr. Modi, as well as Mr. Tanti, for joining us, giving us those detailed outlook as far as the company's business is concerned, though we will hold on to the numbers that you report for the next couple of quarters. With that, we slip into a short break, come back on the other side. We keep our eye out on the market.
Rima is here to tell us what we can expect.
Thanks so much for that. So one of the factors which works in favor of HCL Tech is its valuation. So valuations for HCL Tech are lower than the large cap peers. We're looking at the FY24 PE, and for HCL Tech, it stands at close to about 15.5 times. Well, in the numbers and in the commentary, the key is going to be the margin guidance. Now, just pull up the trend chart of HCL Tech's EBIT margins, and you will see the way margins have fallen. The peak post-COVID was a high of 22.9%. From that level, we've seen the margins fall down to about 17%. This trend is not capturing it, but the post-COVID high margins were 22.9%, which has fallen to about 17%. That's a huge decline that we've seen. Margins in Q1 were a 10-year low. Their guidance is that margins will be at the lower end of 18 to 20%. Even then, the street is not fully convinced that the company will be able to achieve this 18 to 20%. So does the company reiterate its margin guidance? That's going to be very, very crucial. In terms of numbers, we're working with a dollar revenue growth of 1.5%, a constant currency revenue growth closer to 2.5% to 3%, some EBIT margin expansion to about 17.4%, but again, not too much because there is that impact of the wage hike. So margin expansion limited this quarter, and profits, according to the poll, should be up close to about 4%. Back to you.
Take that point, Rima. Thank you so much for that. You can catch the management brief, the press, later this evening at 5:30 p.m. With that, we wrap up on this edition of Chartbusters with the news that the frontline indices have now moved into the red.